With the changes in the 2024 budget, what is now the best way to save for your retirement and what is the optimal drawdown of assets in retirement? Let's look at how it's all changed and how you can optimize your taxes and your life in retirement. The changes are that for general savings accounts, capital gains tax has increased from 10% to 18% for those that are basic rate taxpayers and 20% to 24% for higher rate taxpayers. For ISAs, there's no change. So maybe this was too much hassle to regulate, maybe there was too much of a backlash. But the 20K that you can put into an ISA each year is still frozen and might be frozen for many years to come. And the biggest change was that for defined contribution pensions, these are now going to be within your estate from April 2027, and so therefore they will be subject to inheritance tax, and potentially they could be double taxation on these assets, because when you die there'll be inheritance tax and then your dependent will have to pay income tax at their marginal rate. With regards to saving money for retirement, there's still the risk that you put money into your pension, get tax relief at 20%, and then later on in old age, you take money out as a 40% taxpayer, and possibly after you've burnt through all of your tax-free cash. So that would mean that you're in a worse situation if you'd saved in a pension rather than an ISA. And that's maybe a rare example, but it does stress that maybe younger people are better off parking some money initially into an ISA and then waiting until they are a 40% marginal tax rate payer and then starting to pump more money into their pension and possibly living off some of their ISA that they'd saved in their early years. For managing your finances in retirement, the first thing you need to do is fill up your personal allowance. This could come from a defined benefit pension, rental income, part-time work, or a side hustle. Also, once you're 67, it's likely that the state pension will fully utilise your personal allowance, as the triple lock will remain in place for the next possibly few years. So then what you can do to fill up your personal allowance is to use a defined contribution pension, because that will be taxed at your marginal rate. And often what people do is they use UF Plus to take the 25% tax-free as a part of every withdrawal, rather than the flexible access drawdown where you're taking the tax-free cash up front, but you can still stage it over several years. So just as a quick reminder, here's what UF Plus looks like, where you're taking the 25% tax-free, and here's what the Flexi Access Drawdown looks like, where you're typically taking the tax-free cash first. So once you've filled up your personal allowance, ideally you put together a plan of how you'd like to spend your money between now and maybe the next 30 years. And what that will probably show is that you want to spend more money in the first few years of retirement, because you might have to, for example, replace a company car with a car of your own. You might want to do some home improvements, and things like major trips, you're probably more likely to take them in the first few years of retirement. So that means that the withdrawal rate as a percentage of your wealth is going to be higher in those initial years. And what also happens is that you've got a sequence of returns risk, where if you have poor returns in the first few years of retirement, it can be very difficult for your portfolio to then recover in value. Whereas if you have poor returns in the middle or towards the end of retirement, you've ideally already had some fairly good returns, so there's less to worry about in terms of the overall value of your pension pot. And for that reason, it's best to minimize the tax that you pay in the first few years of retirement, so that you're not pulling too much on your pension and you're not subjecting yourself too greatly to this sequence of returns risk. After we've utilized our personal allowance, we then have options to take money from a general taxable investment account, our ISA, or our pensions. And it's a good idea to run down the general investment account because of the capital gains tax issues, and to either spend that money or migrate it to an ISA. So that means you're going to want to use either an ISA or tax-free cash from your pension in those early years. And then it's a similar argument in terms of SIPP versus ISA. If you take money from your ISA before you take taxable cash from a defined contribution pension, then essentially you are deferring the tax, although your dependents might end up with a greater tax bill upon your death. But that's not necessarily how I would look to optimize my own personal finances. So what I would look to do is to gift money earlier in my life rather than upon my death, and I would look to gift money over several years rather than in one lump sum. And the advantage of gifting over several years is that you can try to make an application to HMRC that you are gifting from excess income, and that therefore the amounts you paid are not subject to inheritance tax. Now, this is quite easy to do if you have a large defined benefit pension and the state pension. So say the combined of those two could be £40,000 a year. You say, well, I only need £36,000 to live off, so I'm going to gift £4,000 every year to my dependents, and that is excess income. From a defined contribution pension, it's still kind of possible to do this, to take more money than you need on the grounds that you have a very large pension that you want to utilize, and you would need to keep all of the records and also do your own research on this issue. It's important to note that gifts from your ISA would be counted as gifts from your personal capital wealth, and so they would not be subject to this gifting legislation. And so with gifts from the ISA, you need to make them 7 years or more before you die. So there's an age 75 rule on defined contribution pensions, which states that they are income tax free if you die before the age of 75, but the whole pension is taxable at the recipient's marginal rate of income tax if you die after the age of 75. So this means that it's ideal to have burnt through your defined contribution tax-free cash prior to the age of 75, because otherwise you risk losing it upon death. Under the old rules, it didn't matter so much if you built up a huge balance within your defined contribution pension, because at least you could pass it on to your dependents free of inheritance tax. But now there might be more of a desire to take more money from your pension and either spend it yourself or give it away to your dependents early. And we're probably going to see more people taking up to the top of their 40% income tax band as a way of managing their money. This means that retiring without some sort of plan as to how your money will last, how you tend to spend your money, isn't really a great idea. And the solution that I would look for is one that is simple, low cost, easy to understand, and tax efficient. I think that the order of drawdown hasn't changed so much following this budget. I would still aim to take from an ISA before a pension, but what has changed is more of an emphasis on having a proper plan in place, making sure that you can gift money without compromising your own lifestyle. And there's going to be more of a desire to effectively die with zero and to show the government that we don't want to pay this stupid inheritance tax. If you're interested in learning more about my retirement calculator, I'll put a link in the description. And if you're interested in learning a bit more about my YouTube channel, watch this next video.